It's over. Not in a dramatic headline sense, in the mechanical sense, the kind that happens when a system reaches a point where every remaining option is damage control, the kind that only becomes obvious in hindsight. The Federal Reserve blinked. And when the world's most powerful central bank blinks, it's not the start of a crisis. It's the admission that the crisis has already crossed the line where normal tools no longer work. This is not about sentiment. This is not about fear. This is about intervention, emergency intervention. Over the past 18 hours, 3 separate internal communications surfaced from 2 different corners of the financial system. All 3 were sent on January the 2nd, 2026, between 2:17 p.m. and 5:43 p.m. Eastern Time. Different institutions, different senders, same message. The Federal Reserve activated emergency credit facilities totaling approximately $24 billion for 3 U.S. commercial banks, explicitly to address liquidity stress tied to concentrated derivative exposures in precious metals markets. That sentence alone should stop you cold. This was not routine lending. This was not discount window housekeeping. This was the lender of last resort stepping in to prevent a cascade failure. And the timing matters. January 2nd, 2026. The first trading day after China's silver export licensing system went live. That is not coincidence. That is cause and effect. 3 banks, all considered well-capitalized, systemically relevant institutions, went to the Federal Reserve and effectively said, if you don't intervene now, we fail. Not next quarter. Not after an earnings call. Now. And the Fed complied. Let's be clear about what that means. Emergency credit facilities exist for one reason. The institution cannot meet its obligations with available liquidity. Period. When the Fed opens that door, it's because the alternative is disorderly failure. Now let's walk through the evidence. The first communication was sent at 2:17 p.m. Eastern, roughly 5 hours after COMEX opened. It notified counterparties that the institution had secured access to a Federal Reserve emergency liquidity facility, coordinated with the New York Fed and the Board of Governors. The stated reason, heightened volatility and concentration of exposures in precious metals, futures, and options. Translated out of Fed and corporate language that reads as follows. Silver moved violently, the bank was on the wrong side, and margin requirements exceeded available cash. The email assured counterparties that obligations would be honored. That line is never written unless honoring them has suddenly become a question. Now look at the price action that morning. Silver opened at $79, up from $72. It rallied to $84 by late morning. For a bank short silver at an average entry between $60 and $65, that move is catastrophic. At $84, losses range from $19 to $24 per ounce. If that bank was short 10,000 contracts, 50 million ounces, losses approach 1 billion. Margin calls follow price, not opinions. The clearinghouse doesn't care about narratives, it cares about cash by deadline. So the sequence is straightforward. The price gapped, losses exploded, margin calls arrived, cash was insufficient, the Fed was called. The second communication arrived later that afternoon, sent at 3:52 p.m. This one referenced activation of a standing Federal Reserve credit agreement due to unprecedented volatility in precious metals markets following the implementation of export controls by the People's Republic of China. That is explicit. That is not coded language. That is a direct acknowledgement that the Chinese export ban is destabilizing the derivatives market. The phrase enhanced margin and collateral management means one thing. Collateral demands exceeded internal buffers. The reassurance that this should not be interpreted as a distress signal is, historically, the clearest indicator that it is exactly that. The third message, sent at 5:43 p.m., is the most revealing. It was internal. No counterparties, no clients, staff only. It announced expedited access to the Federal Reserve's discount window coordinated with regulators, and instructed that no client-facing communication was required. That is emergency protocol. The discount window is not a preference. It is the option used when funding is unavailable elsewhere. Expedited basis means the bank could not wait overnight. They needed liquidity immediately after the close, once the price failed to retreat. Silver closed at $81 that day, still up $9, still deeply underwater. Now put this together. 3 banks, same day, same market, same trigger. Emergency Fed liquidity, combined credit availability approximately $24 billion. Roughly $10 billion or $9 billion and $5 billion respectively. Why so much relative to current losses? Because the Fed isn't covering what already happened. It's bracing for what happens next. Combined estimated short exposure across the 3 banks, approximately 21,000 contracts, or 105 million ounces. At $84, combined losses are roughly $2.2 billion. The Fed provided more than 10 times that amount. Because they understand trajectory. If silver moves to $100, add another $1.7 billion in losses. At $120, losses balloon dramatically. At some point, credit lines stop being sufficient. At that point, positions must be closed. And closing short positions of that size is not a smooth process. It is forced buying, regardless of price. That is how vertical moves happen. This is where the larger system problem emerges. The Federal Reserve cannot allow these banks to fail. Counterparty exposure alone would cascade through clearinghouses, derivative books, and credit markets. But the Fed also cannot socialize unlimited losses indefinitely without political consequences. Emergency liquidity is a bridge, not a destination. January the 2nd matters, because that is when the market was forced to reprice reality. The export licensing regime went live January 1st, Beijing time. Markets were closed. On January 2nd, institutions returned, processed the data, and reacted. 47 Western companies denied supply, 0 exports recorded, Shanghai pricing near $89, Western dealers quoting $115 to $125. That information hit simultaneously. Buying followed. Shorts were exposed instantly. The Fed stepped in, not because this is over, but because it is beginning to escape containment. What happens next follows a familiar pattern. Initial stabilization using emergency liquidity, attempted gradual position reduction, efforts to avoid signaling distress, and then, inevitably, a point where covering accelerates faster than liquidity can absorb it. When that happens, price doesn't negotiate, it gaps. This is why the focus on paper instruments becomes dangerous: futures, ETFs, and unallocated exposure function. Only while settlement confidence exists. Once force majeure enters the conversation, paper prices decouple from physical reality. And that is the end game risk. Not tomorrow, not guaranteed on a schedule, but structurally unavoidable if the underlying imbalance is not resolved. The Fed's $24 billion intervention is not proof of control. It is proof of fragility. It is the central bank acknowledging that the silver derivatives market can no longer self-stabilize under current conditions. Time has been purchased. Nothing has been solved. And time in leveraged systems only increases pressure. That is the signal. Not hype, not fear. Signal. When a lender of last resort intervenes on day one, it is because the system already failed the stress test. The rest is just arithmetic.
Hello my friends, welcome back today my new video. So friend, it's our not in a dramatic headline scenes and a mechanical scenes. The kind that happens when a system reaches a point to where every remaining option is dramatic control, the kind that only because obvious in the hand side the Federal Reserve blanket. And when the world's most powerful control bank blinks, it's not the start of the crisis, it is the admissions that the crisis has already crossed the line where normal tools no longer work. This is not about sentiment. This is not about fear. This is about intervention, emergency, internation. Our the past 18 horse year spirit international communications surfaced from two different corners of the financial system. All there were sent on January 20, 2026 between 2:17 p.m. and 5:43 p.m. Eastern Time, different in situation, different seconds. Some messages: the Federal Reserve activate emergency credit facilities totaling opportunity 24 billion for three-year US communication banks explicitly to address liquidity straits tied to contract reservation exposure in the precious metals market. That sentence alone should stop you cloud. Thank you so much.